Okay, let's jump right on it. We're in chapter 16, and last time we talked about taxes, issuance costs, and dividends. And so far, what we've said is that there are a lot of things that favor repurchases. For one thing, when you do a repurchase, if the shareholders don't want to incur a tax at that time, what do? They just don't sell their shares. With a dividend, you're kind of forced to pay, or you're forced to pay taxes when they pay you the dividends. And then secondly, we have the fact that the entire amount of the dividend gets taxed, but only the capital gains portion of a share repurchase gets taxed. And so it's really tax beneficial to the shareholder to get a share repurchase. So you might think, well, wait a minute, why would anyone pay high dividends? And we're going to talk about some of those issues right here. First of all, there are groups of people, and we're going to call them clienteles here in a minute, but groups of people who desire current income from shares. Now, we know that you can create homemade dividends, and we're going to talk about that here in a second. But for right now, picture people who depend totally on their investments in order to be able to eat, pay their rent, and those sorts of things. We used to really crassly call these widows and orphan stocks, because you could, hopefully the dad had bought a bunch of these stocks and then died, and then mom and the kids could live off the dividends. And so that's why we call those widows and orphan stocks. Today, more likely we would think of them as retiree stocks. My dad loves dividends because that's how he's funding his consumption right now. Okay, now let's get on to the argument then. It's like, hey, wait a minute, couldn't these widows and orphans just sell like 3 shares every month and have the money to do what they need to do? And that's where behavioral finance jumps in. So in behavioral finance, we've got these 2 guys, Kahneman and Tversky, and you don't have to remember their names. But basically, they said, the efficient market hypothesis says that people are rational. And that's not actually what it says. What it says is that markets behave as if people are rational. You don't have to have everyone in the market be rational. But they did a bunch of experiments with people, and what they found is that our models for how people think probably not quite right. And one of the things that we see is that people lack self-discipline. And anyone who's ever sat down on a couch and opened a bag of potato chips knows this problem. So if you said in your head, I'm only going to eat 15 potato chips when I sit down, and then you open the bag, how many chips are you going to eat? The whole bag, right? And so this is the same problem with starting down the slippery slope of selling shares. You're like, wow, when I sold 2 shares, I got $1,000. I could sell 3 shares next month and get $1,500. Woohoo! What's the problem with that? Is it sustainable? No, eventually you run out of shares to sell, and of course you're hungry. And so the argument is that companies pay dividends and that the people, therefore, are not even tempted to sell their shares. They get the dividends, and so people will prefer that to, say, capital gains. And so that makes sense. So this is an argument against homemade dividends. Then we have the agency costs. Remember that people are scumbags. People are scumbags, and managers are people. And so by transitivity, we have that managers are scumbags. And so the argument here is that companies pay out these dividends to, and by the way, the board of directors declares the dividends just to keep that money out of the hands, the grubby hands of the managers. And I've seen this before. We would be having a great quarter or a great year, and we would say things like, we've got lots of money. We've got money to burn. Did we have money to burn? Whose money is it? Oh, come on. It's the shareholders' money, right? It's the shareholders' money. And so we should be returning it to the shareholders. Instead, what are we doing? Well, when it comes time to renew that, release a new corporate company car, well, instead of getting the Honda Civic, maybe I'm getting the Accord. Instead of the Accord, maybe I'm getting a Lexus, right? And then we had free coffee at this one place where I worked, and it was totally awful. It was Maxwell House, and times were extraordinarily good. And this was when Keurig or Querig, whatever it's called, first comes out, and these coffee pods were like $3 a piece. I mean, it was crazy because they had a patent on it. Anyway, and times were good. Well, we got one of those machines, and we all got to have our little flavor of whatever it was, and just the coffee budget just went crazy. Well, and people started, instead of flying economy, they're flying business class and things like that. Was that our money to spend? No, it's the shareholders' money. So how can we keep the money out of the hands of the managers? Well, if you pay it out to the shareholders, that money's not there tempting managers to burn through it. There's probably a better example for you guys. You guys go out for a night on the town. One of you has, let's say Mr. Sith has $300 in his pocket, and Mr. Crawford has $100 in his pocket. Who's going to spend more on booze? I assume you both drink. I'm just making, you don't have to confess, but
It's a harsh assumption.
it's a harsh, and then he looks hungover. Okay, so let's, two people here that do enjoy going to bars. Mr. Dexheimer, do you enjoy going to bars?
I drink at home. It's
You
cheaper.
drink at home, it's cheaper. That's a smart man right there. Oh, come
Most
on.
bars don't put the egg white in whiskey sour.
Ew, that's disgusting. What's that?
I told Andrea yes, she should raise her hand.
Oh, okay. Well, let's assume that you two ladies, no, and the bad thing is though, ladies tend to have cheaper evenings out. Because there's the ladies' night thing, and then there's the chance that someone will buy you a drink, right? I've never had anyone buy me a drink. Never, never, never. Okay, so just roll with me here. Assume that you do frequent bars. Which of you is going to... Yeah, the guy with more money in his pocket's going to spend more. Have you ever heard the expression, that money's burning a hole in your pocket? Yeah, if you've only got 100, you're going to be a little more conscientious with that. And that's what we're doing. We're sending the managers out with less money in their pocket, and there's a good chance they're going to spend less. Does that make sense? Okay, and then we have the information, content, and the signaling of dividends. So let's talk about dividend signaling. So we talked about earlier, if, from the market value balance sheet perspective, that when a company pays a dividend, that the stock price should go down because we're actually paying out a portion of the equity, and it does. But what about if someone increases the dividend that they're paying? What do you think the market says when someone increases the dividend that they're paying? Yeah, the company's doing well. Remember, we said dividends are sticky, meaning that managers are reluctant to raise them because they know there's an asymmetric response in the market to dividends. If you raise your dividend, you get a light pat on the back. If you lower your dividend, you get a swift kick in the butt. So there's this huge downside to cutting dividends. There's a small upside. And so managers are reluctant to raise their dividends until they know with certainty that they won't have to cut them, which means that they see these increased earnings that they're experiencing are going to be sustainable. Does that make sense? Okay. By the way, trends that blow up fast, what tends to happen to them? Yeah, they tend to go away fast. And so when you look at things like Pokemon Go, I don't know if you remember when Pokemon Go came out, it was like, whew! Now, what if the company at that point had said, wow, this Pokemon Go thing is amazing, we should raise our dividends really big? What would have happened like 6 months after? They'd have to cut them, and then their stock would be punished. And so what I'm telling you is, if you find yourself with one of these things that blows up really hurry, be patient about raising your dividends, because there's a good chance this thing's gonna flare out and come back down. Another one was Beanie Babies. You guys are too young to even remember Beanie Babies, but oh my goodness, it was awful. Okay, so watch out for these things that flare up and then go away, because you can get yourself in a world of hurt if you raise your dividends for them. Okay, questions? We actually know that the increase in the dividend should push the share price down further on the ex-dividend date, but when the announcement comes out, it's the announcement of the increase that makes the stock price go up. So now let's talk about the clientele effect. And we're going to make the argument here that if there are people who prefer a high dividend payout, then they are going to bid up the stocks that pay high dividends. But not everybody desires a high dividend payout. And so at some point, we're going to reach what's called an equilibrium. An equilibrium. So if we haven't reached that equilibrium yet, and we've got a lot of people who are desiring high dividends, then a company can actually boost its share price by declaring that they're going to start paying dividends, because that clientele then will then bid up their price. But what if we already have enough high dividend paying firms to satisfy the clientele? Would you be able to create value for your shareholders simply by declaring a dividend at that point? The answer is no, because they've already satisfied that clientele. So what kind of clienteles are we talking about here? Well, let's break them down into four groups. High tax bracket individuals prefer zero to low payout. So let's talk about high tax bracket versus low tax bracket. I'm not talking about extraordinary amounts of income here. I'm a state employee, you know I'm not getting rich, right? But I still have a high enough tax bracket that I would prefer instead to put things off and have capital gains later. And so that is that clientele. Those people do not favor dividend payout. But then we have low tax bracket individuals. When do you think you make more money? In retirement or during your working years? For most people, they make more in their working years. And under a progressive tax regime, it means their tax rate is higher during their working years. As a result, these people who are now retired, they are in a lower tax bracket, and they would prefer dividends to capital gains. The other thing is this, the capital gains, there's a chance they might not even get to enjoy them, right? Because my dad's 82. I don't know how much longer he's got. He's still pretty healthy. He's only got one kidney, but he's making it work for him. Now, how much longer do you think he has? I don't know. But will he be able to enjoy capital gains? Who knows? But he does enjoy getting those dividends. And I showed you the slide or the article with the percentages. He's paying not as much tax as you or I would, simply because he's got no salary he's got no income other than those dividends plus Social Security. Okay, then we have tax-free institutions. Tax-free institutions are looking at a median payout. So what do we mean by a tax-free institution? Pension funds. Pension funds. And so they're looking for a median payout. It means that they're looking for a combination of current income and capital gains. And it makes sense, because what are they doing? Well, they're having to, on the one hand, make payments to the current retirees. And so that would make it good for them to have the dividends. On the other hand, they want to be able to grow their, let's call it their endowment, to spit off more cash flows in the future, so they want capital gains out of that. So it makes sense that they're kind of balanced. Now, corporations, the slide says high payout. When this thought came out, the corporate ability to ignore dividends was 70%. So 70% of your dividends received were non-taxable. The tax law has recently changed. Now only 50% of dividends are non-taxable. And so my guess is corporates are not as high on receiving dividends as they used to be, simply because they cannot exclude as much in dividends from the taxable income that they get. So what's the argument for not making corporations pay taxes on dividends? And the answer comes down to the way the money gets taxed at a corporation. If you think about the corporation making $1, and then they have to pay, say, 25% in, well, let's make the math easy. If they have to pay 20% in corporate taxes, now we're down to 80 cents. And then they pay the dividend to the shareholder, and the shareholder has to pay a dividend or a tax of 20%. So now we're down to 64 cents of that original dollar is still out there. If a corporation was the recipient of that dividend and then they had to further pay corporate tax on it, that would be triple taxation. And so triple taxation, and by the way, so the idea would be this, that the corporation that receives the dividend has to pay on it, and then they turn around and pay it up to the shareholder who has to pay yet again. And so that's how you get triple taxation. And so apparently double taxation in the United States is just fine. Triple taxation maybe is a bridge too far, and so that's why we have an exclusion for corporations receiving dividends. It's not perfect, it's not 100%, it's only 50%, but it's better than nothing. Now, if you didn't want to have to pay taxes on the dividends of the shares that you owned as a corporation, here's what you'd have to do. You'd have to go out and buy up at least 80% of the shares of the company that's paying you the dividends. And at that point, it's considered an unconsolidated subsidiary, and it's actually considered basically a part of the company. And so the dividends that they pay to the company are no longer considered dividends, but they're considered transfers within the firm. And transfers within the firm are not taxed. Transfers within the firm are not taxed. Let's see. So we've already talked about this. Once the clienteles have been satisfied, you're not going to make any value by changing your dividend policy. If suddenly we had a bunch of people who desired dividends, you would need to be one of the first companies to then start paying a dividend in order to enjoy the share price benefit that comes from that. Otherwise, you're not really gaining anything. Questions? So what do we know and what don't we know? Well, we do know that dividends are large in the aggregate. What does aggregate mean? Altogether. So we're talking about here, if you total up all of the dividends paid by all the firms, they're huge. We do know the numbers of companies that pay have declined. The number of companies that actually pay dividends has declined, but the amount of dividends has actually gone up. There was a paper in 2001 by Fama and French, and they say, oh, dividends are disappearing. And then I think it was like the next year or two, D'Angelo and Skinner come out and say, dividends aren't disappearing, dividend payers are disappearing, because they showed that the dividends in the aggregate have actually gone up. So if you roll back to the old days, many newly listed firms would actually pay dividends. And there are some reasons for that. Number one, firms used to be older when they went public. So a firm was more mature when they went public. They were later in their life cycle when they went public. So it makes more sense that they would pay dividends. And back then, we had strict enforcement of what was called the prudent man rule for pension funds and endowments. And the rule was that the pension fund or endowment should only invest in stocks that a prudent man would invest in, and that was often taken to mean a dividend-paying firm. And so if you wanted to make your stock attractive to institutional investors, which by the way you do, because the more people that want to buy your stock, the higher the value is. If you want to make yourself attractive to those people, you had to pay dividends. So we've kind of backed off of that now, and the companies are younger, so that tells us why the number of newly listed firms paying dividends is lower. We have seen that tax policies matter, but they're not a major deterrent. In my lifetime, I have seen dividends taxed as ordinary income. Ordinary income taxed up to almost 40%. And did we see dividends disappear during that time in aggregate? No. I've also seen during my lifetime when we cut the dividend tax rate and made it the same as the capital gains rate back in 2002, 2003, about that time frame. Did the proportions of firms paying dividends massively shift as a result of that? No. Did the dividends in aggregate massively shift because of that? No. So tax policy maybe doesn't impact things as much as our models would tell us that it would, that the tax policy would. So we've got fewer companies paying dividends, but they are paying more dividends. So the ones that are still paying dividends are paying more. Questions so far? We also know that corporations smooth dividends. Remember we said dividends are sticky, that people are unwilling to raise the dividend because they don't want to have to face having to cut the dividend because they'll get beat up in the market over it. Well, one of the things that we see happening then is the smoothing of dividends. What does that mean? We're not looking at a set payout ratio. So if you've got a set payout ratio, it means that, let's say it's 50%. And I've got net income of 100 million. I'm going to pay out 50 million in dividends. Well, the next quarter I've only got 60 million, so I pay out 30 million in dividends. And then the next quarter it's 200 million, so I pay out 100 million dividends. That is not smooth. That is not what companies do. We see very few companies actually focusing on maintaining a constant dividend payout ratio. What they focus on instead is paying out a constant but perhaps slowly growing dividend. And the reason they do that is because of this asymmetric response we see in the market, where when you raise it, you get the slight pat on the back. When you lower your dividend, you get the big kick in the butt. We do know that dividends provide information to the market. If you go out there and say that you're going to increase your dividend, we know that share prices respond to that favorably. They go up. What do you think happens when someone says, I'll give you an example. It hadn't been too long ago that Ford had to cut their dividend by about 50%. What do you think happened to their stock that day? Yeah, they got beat way up. Now, what was the signal Ford was sending?
They need extra revenue.
Yeah, we're in trouble. That's the signal that you're sending. And in fact, what we'll see getting back to smoothing is that people will actually borrow money to pay a dividend to avoid sending the negative signal that they're in trouble. If the problem's just temporary, that works just fine. If the problem's permanent, can they continue that? No. So we see that firms should follow a sensible dividend policy. What's a sensible dividend policy? Well, as we said, do not forgo a positive NPV project just to pay a dividend. Remember the goal. What's the goal of financial management? Maximize shareholder wealth. Do we get that by rejecting positive NPV share projects? No. And so we're always going to accept those positive NPV projects. If we can get funding, we would rather do that than pay a dividend. We should definitely avoid issuing stock to pay dividends because, number one, we're going to have to pay flotation costs to the underwriters. And number two, when we pay those dividends to the shareholders, they have to pay taxes on it. And so if we issue $1 worth of shares to pay a dividend, we're only going to get 92.5 cents back from the investment banker, and then we're going to turn around and give that to the shareholder that's going to have to pay 15-20% tax on it. It doesn't make sense to issue shares to pay dividends. And we should consider a share repurchase when there are few better uses for the cash. How do we know when we don't have better uses for the cash? I'll get you started. When we have no positive NPV projects. If we've got no positive NPV projects, we need to be returning that cash to the shareholders. And we said there's two ways to do it, dividends and share repurchases. Now, if we find ourselves, let's say we sell a division and we get a lot of cash out of that and we don't have positive NPV projects for that cash, we would be better off to do a share repurchase because this is a one-time lump of money that we've got. We don't want to raise a dividend because this is not going to be a continued thing, right? And so it makes perfect sense in that sense to go ahead and do a share repurchase. Questions? What does the BSG say about dividends? What are the expectations? We're expected to? Yeah, we're expected A, to pay them, and B, to increase them. There's a rate of increase over time that's expected. If I were you, that's what I would be doing in the BSG. And if you have extra money, do share repurchases because then it boosts your ROE, your EPS, and things like that. Questions? Okay. So what we're going to put it all together here. We said aggregate payouts are massive and they have increased over time even though we have fewer firms paying, and that's because the dividends are concentrated among a small number of large mature firms. Why do you think mature firms would pay more dividends than young firms? They're established. What does that mean?
I don't know, they know what they're doing.
They know what they're doing. I like that. How about this? When you're first starting out in a business, hopefully you've got into a business that's got some growth opportunities. Hopefully you've got lots of positive NPV projects. So would it make sense at that point for you to pay dividends? No, we said don't forgo positive NPV projects to pay a dividend, right? So what happens though over time? Can something grow at a rate of 50% per year forever? No. And so what you find is over time that the opportunities for growth at these firms are outpaced by the money that's coming in. And so at that point, they're going to start doing dividends and share repurchases. And so that's why we see these large mature firms paying dividends and the younger, I say, the immature firms not. We know that managers are reluctant to cut dividends because they don't want to get smacked around by the market. We also know that they smooth dividends for the same reason. We don't want to be flying all over the place because we'd be sending signals to the market even if we didn't mean to. We know that the stock prices do react to unanticipated changes in dividend. What's the magic word in that whole sentence? It starts with a U. Unanticipated. If it were anticipated, what would have already happened? Yeah, the stock price would have already reacted. So, in case nobody mentioned it to you earlier in your financial education career, information gets put into the stock price pretty darn quickly. So, when I was an engineer and I didn't know any better, I started to get some money and I subscribed to a magazine called Business Week. And so it would come on Thursday in the mail or whatever, one day of the week. And I would get home from the factory at like 6 or 7 o'clock at night, and I would sit down to read my Business Week, and they would have this, stock of the week that they were pushing. And I would look at it, and I'm like, that does sound like a good argument. Now, here's the problem. I didn't get that magazine until that night. People that were sitting at home and got the magazine at around noon in the mail, what did they immediately go out and do? If there was information there, they acted on it, they bought the stock. What did that do to the stock price? Yeah, it went up. By the time I would get around to putting my order in the next day, any of that news was already in the stock price. Any potential for extra profit was gone. Does that make sense? I only really ever bought one stock based on that recommendation, and that company went bankrupt. So I'm telling you, don't buy stocks that are advertised or that are pushed in publications. And we know that the size of stock repurchases tends to track with the unanticipated with the transitory earnings. What does transitory mean? Did they teach you nothing in your English classes? Transitory. So, does anyone know what a transit system is? What's a transit system?
Where buses take you around the city.
Yeah, where we're moving, right? So these transitory, meaning that they come and they go, right? They come and they go. So if you've got transitory earnings, ones that just showed up big, and then you know they're going to go away, kind of like if you had Pokemon Go, then you would use a share repurchase for that, as opposed to what we would call the more permanent earnings of the firm. The permanent earnings are the ones that we're pretty sure are going to happen again and again and again. For example, think about Google. The biggest source of revenue at Google is their AdWords. So when you put in a search and they got the sponsored links and whatnot, that's their biggest source of revenue. And if I were Google CEO, I would be thinking that as my permanent earnings. But what about when they do something like sell their self-driving car business? That's more transitory. I would use a share repurchase instead of doing dividends for that. Questions? So what does a sensible payout policy look like? Well, we're going to pay out all the free cash flows over time. What is the free cash flow? It's the money we have left over after setting aside a sensible cushion for liquidity and funding all of our positive NPV projects. After we've done that, anything that's left over, assuming we've already paid our bond coupons and whatnot, that is our free cash flow. And by definition, that is not something that the company can invest profitably, because after all, if you've used all of the positive NPV projects up, what's left? Zero and negative NPV projects, which we don't invest in. We've talked about this one before, so we're going to skip that. Wait to initiate the dividends until the free cash flow is substantial. This returns to our discussion about mature versus immature companies. They're going to wait until that free cash flow is substantial before they initiate the dividend, and that means it's going to be down the road a ways for most companies. Set the current regular dividend consistent with a long run target payout ratio. So we said that they don't stick to a hard and fast payout ratio, that we're going to pay out 40% every quarter of our earnings, but they might have a long-term one. And so they can actually come up with a target of what they want to pay out over time. And then their smoothed dividends should be meeting that long-term payout target. So you guys set the dividend low enough to avoid expensive external financing in the future. You don't want to be raising your dividend only to have to go out to borrow money to make the next dividend payment. And we know that the cheapest form of financing is it internal or external? Internal, right? You made that money, you don't have to pay flotation costs for it. And so the thought here is we want to set our dividend low enough to avoid external financing. So what does that mean? Not only are we going to avoid external financing for paying the dividend, but we would also like to use our internal equity for funding the equity portion of our new investments. Does that make sense? So I'm not going to pay out $1 million in dividends only to go out to issue $1 million in shares to build a new factory. That's not something I should be doing. And once again, we use repurchases to pay out temporary cash flow increases, not dividends. Now let's talk about stock dividends. Stock dividends is where you get additional shares instead of cash. And usually it'll be like a 2% stock dividend or 5% stock dividend. And what that means is, on a 2% stock dividend, if you owned 100 shares, you would now have 102. Does it matter at all? No. All it does is increase the number of shares, and that sounds good, but it hasn't done anything to increase the value. So what does that mean to the share price? It's actually going to go down. And when you look at the value of your shares the day before the stock dividend and the value the days after, assuming nothing else has happened in the world, they should be exactly the same. And then we have this silly distinction about small stock dividends and large stock dividends. We say that small stock dividends are less than 20 to 25%, and the large is more than 20 to 25%. Why are those definitions problematic? Yeah! Well, there's no bright line, right? Now, what does that mean to you? If I gave you a problem where I said small or whatever, I would tell you this is a small stock dividend, this is a large stock dividend, and we would make the numbers such that hopefully no one would get confused, right? But to me, that's just silly, right? You should have a bright number there that you look at. But of course, this is accounting that makes this rule. And by the way, we're going to see that the accounting is different based on large or small. So here we go. We own 100 shares worth $50 each. The company declares a 10% stock dividend. How many shares are you going to have afterwards? You had 100 before, now you're going to have 110. Very good. So, but what was the total stock before, or total wealth before the stock dividend? Well, it was 100 times the $50 a share. So we're looking at 5,000 shares, or $5,000. But now you've got more shares to spread that over. So we're going to take that 5,000 and divide it by 1.10. So sorry, we're going to take that 5,000 and divide it by our 110 shares, and that's going to give us $454.50. Sorry, I'm having trouble today. Did you guys notice that? Yeah, sorry about that. Okay, so you get the idea here. The number of shares went up by 10%, and so we're dividing by basically 110% to figure out the new share price. So the share price is going to be lower. And so what we see is that the total wealth afterwards is exactly the same as before. And so the bottom line is these do not affect shareholder wealth. In fact, I would say that statement is not quite true, and here's why. Do you think there's a cost to declaring these things? Oh yeah, especially back in the days when people had stock certificates. And now for everyone that had 100 shares, we have to mail out another stock certificate for 10 more shares. There's a cost associated with that stuff. And who pays for that cost? The shareholders. And so frankly, I have trouble seeing any good rationale for paying a stock dividend. And by the way, of course, it's not really paying because there's no money involved. Let's talk about stock splits. And so they're essentially the same as a stock dividend, except for they're expressed as a ratio. We said the stock dividend, you would say it was, like 8% or 50%. With a stock split, you'll hear it said 2 for 1 or 3 for 2 or something like that. And so that's why we explain those as a ratio. And so a 2 for 1 stock split would have exactly the same effect as a 100% stock dividend on the share price. The big differences we're going to see is how those things are accounted for. We'll see that in the practice problems. So you've got 100 shares worth $50 each. The company declares a 2 for 1 stock split. Your total wealth beforehand is $5,000. Afterwards, you're going to own 200 shares. Those shares are still going to be worth $5,000 because each share is worth exactly half of what it used to be. Now you notice it says total wealth after stock dividend down there. I want you to scratch out the word dividend and write split. You see that where it says stock dividend? Scratch out the word dividend and write split. So once again, doesn't impact shareholder wealth other than the administrative costs of sending out the new stock certificates. By the way, there are people who religiously follow companies that are going to split their stocks, and then they buy the stock because they think that stock splits are going to increase the, when you multiply by 2 or whatever, that it's going to be higher than it was before. We will talk about perhaps why that might actually be true, but is it something you should do? Probably not. So we're talking about very, very minor things that we could use to make that argument. There are entire websites devoted to tracking stocks that are going to split. Then we have reverse stock splits. This increases the price per share and reduces the number of the shares outstanding. So here's our example. We've got 100 shares for $5 each. They declare a 1 for 5 stock split. 1 for 5. So if you had 100 before, you divide that by 5. Now you've got 20 shares. What does that do to your share price? Well, it makes it 5 times larger. And so now each share is worth 25 bucks. But if you multiply 25 by 20, what do you get? Right back to where you were. Right back to where you were at 5,000. So it doesn't impact shareholder wealth. So let's talk about why you would do a reverse stock split. Any ideas why you would want your share price to be higher?
If all of your competitors have higher stock prices.
Okay, so you might want to be in the same neighborhood with your competitors. I'll buy that. What about the listing requirements on the major exchanges? Do you think they have price floors that they would delist you under? Yeah, that's the big one. A lot of times you'll see these firms and their stock will get down pretty small, and then they'll do a reverse stock split, so they'll keep their share price high enough to stay listed on the exchange. And so the reverse stock split, I totally see the rationale for doing that. Is it necessarily good news? No. Why do people have to do this? Because they suck. And their stock price gets so low that they're being threatened with delisting. And so that's not a good sign. Let's talk about why you might do a stock split. So let's take Berkshire Hathaway, for example. Do you guys know Berkshire Hathaway? It's probably the most expensive stock out there. I don't even know what it's selling for today. But the share price is so high, most people can't afford to buy even one share. How could they make that stock available to more people? Yeah, they could do a stock split, and it would bring the value down to where a greater number of investors could purchase those shares. Now, Warren Buffett says he doesn't want to do that because he doesn't want us poor folks involved in his. He wants these really brainy, rich people who have lots of patience and whatnot. This is just kind of his thinking. What about regular companies? Do you think regular companies want to have the broadest possible array of shareholders? Absolutely. And so what they're going to do is they're going to stock split, and that's going to put it into this range where more people could afford it. The bigger argument is that it puts the stock into a more favorable trading range. So remember how dealers get compensated for making a market in stock. It's the difference between the bid and the ask. And if you've got a highly liquid stock, that bid-ask spread is only going to be a penny or two. Now, which would you rather hold an inventory of? An inventory of stocks that were selling at $25 with a bid-ask spread of a penny or two, or ones that were $2,500 a share with a bid-ask spread of a penny or two? I'd much rather hold the smaller inventory, right? Because I'm going to make more on every share that I sell as a percentage than I would with the $2,500 share. And so that's why we call it putting it in a more favorable trading range. It means that it's putting you in a situation where more dealers might want to carry your stock in their inventory. More dealers will be posting bid prices. More dealers will be posting ask prices. It's going to increase the liquidity of your stock. And we know that the more liquid an asset is, the higher the premium it can sell at. There's this liquidity premium. Okay, now, long story short, None of these things impact shareholder wealth, stock dividends or stock splits. I think we've discussed, let's see, some of this. Moves it to a respectable trading range where you could get listed on the stock exchange. That's number 3. Liquidity may be improved after the split. By the way, when you see stocks down trading for 21 cents, if it's the first time you've been exposed to the stock, what are your immediate thoughts? Yeah, pass. Unless you're one of these penny stock freaks. And by the way, those people are just waiting to be ripped off. If you want to know how to rip people off penny stocks, just watch The Wolf of Wall Street, right? It's a good show. So, what are you doing here? You're back into a range where people might actually be interested in buying and selling your stock, and so that makes it more liquid. And this is actually I guess it's a realistic thought. The transaction costs to the shareholders will be reduced after, because instead of, if you did a 5-for-1 split, instead of paying that bid-ask spread 5 times, you're only paying it once. And so it's the opposite of the argument for the stock split, and that is that we're making the transactions cost better for the shareholders. And that's it. Questions?
So you have Berkey A's and Berkey B's. They reflect the same company but at different marginal prices.
Yeah.
What's the point of that? And that's
Okay.
the only company I've seen that in.
Right. And so back a long time ago, people were clamoring about wanting Warren Buffett to actually split the A shares, which I think are the expensive ones.
Yeah, they're like 27 grand.
Yeah. And instead he said, no, what we're going to do is we'll have these B shares. And so basically what the B share is just a fraction of an A share. But he didn't want to spoil his overall big A share price by splitting the stock. You can go back and Google and see what the Wall Street Journal articles were at the time. It's not a normal move.
So any company can do that?
Oh yeah, any company can have multiple classes of shares of stock. And usually they have the rights to the same cash flow rights. In this case, they don't. Usually what they've got are differential voting rights. So you and I have the same right to cash flows at the firm, but I've got 10 votes, you've only got 1. By the way, I'm the founder, and you're just some schmuck off the street. Because I'm the one who set up the structure of me having 10 votes, and you only having 1. So that's usually the way we see the different classes of shares. Berkshire Hathaway is a weird situation.
Are the portfolios the same as far as like all the assets?
I think the underlying assets are the same.
Okay.
And if I had to guess, the returns are going to be the same because they're going to move in tandem, right? That would be something interesting to go out there and see what was the correlation between the returns on the A shares and the B shares. I can't tell you what they are, but I can tell you with certainty one thing. They're not perfectly positively correlated because nothing in this world is. Even things that represent exactly the same underlying assets. And the example is Royal Dutch Shell. Royal Dutch Shell used to be 2 companies, and one was in Britain and one was in Holland. And the shares, actually it's a combined company. So the shares represent exactly the same underlying cash flows. And so the share prices should move exactly in lockstep, but they didn't.
Tax rates?
No, at the time the tax, there's no difference in the taxes. Everything's same. That's why it was such a lovely natural experiment. At the time, everything was same. And so it didn't make any sense. Now, were they highly positively correlated? Of course. Were they perfectly positively correlated? No. Good question. Other questions? By the way, would you want to buy 2 perfectly positively correlated stocks? No. You get no diversification benefit out of
Your
it.
stocks are the same.
Yeah, you might as well just buy twice as much of the one, right? They're perfectly positively correlated. Okay, so let's trot out some examples here. Next time, by the way, 4 of you have actually started this. That's just sad. And my first one that I'm interested in is question 51. And that's the first of the calculations. If you have questions on any of the others, please bring them next time and we'll talk about them. So this one says, assume the stockholders of Gandhi Company are in the 24% tax bracket. The closing price of the stock today was $65.18 per share. The firm pays a quarterly dividend of $1.15 per share. What's the expected opening price of the stock tomorrow if tomorrow is the ex-dividend date? Ex-dividend means it trades without the dividend. We know that the value of the stock should fall. If we lived in a world with no taxes, how much value would the bless you, what would the stock price fall? How much? If we lived in a world with no taxes? Yeah, $1.15. But if we're living in a world where we're in the 24% tax bracket, that means that our investors are only going to be receiving $1.15 multiplied by 1 minus 0.24. So that's what they're going to be receiving. So that's going to be the reduction in the share value. And so if they're currently trading at $65.18, and then we subtract that amount, then we can see that the stock's going to trade for $64.31. It doesn't drop the whole $1.15. Does that make sense? Okay. The next one I want to talk about, oh, come on, is 55. A firm's balance sheet is shown below in market value terms. That's important. There are 10,000 shares outstanding, and they say they declared a dividend of 65 cents per share after the dividends are paid. Okay, so what's going to get affected here? Dividends consume what? Okay, they're going to reduce the equity, right? And how much are they going to reduce the equity by? 10,000 times 65 cents, right? So that's going to be how much? $6,500? Very good. So equity is going to go from 248,000 down to 241,500. So that's the first one that we know is going to change. What's the other one that we know is going to change? Yeah, the cash is going to go down as well. And that's going to keep our balance sheet balanced. And so it's going to go down by $6,500, so $73,000 minus $6,500 gives us $66,500. And then we also know that fixed assets are not affected by dividend payments. And so it makes perfect sense that those fixed assets are going to stay the same. And so that top one is the correct answer. Questions? Okay, now let's talk about number 56. Number 56 has a problem. Number 56 is jacked up. Here's why. Let's read the problem. Bridget owns 400 shares of stock that will pay a special dividend of $6.85 per share 1 year from today, and a final 28 cents per share in dividend 2 years from today. Bridget does not desire any dividend income during year 2, but wants all of her dividends in year 1. She can borrow and lend at 9%, ignoring taxes. What would be her total? And scratch the word homemade there. It should be the total dividend in year 1. What's going to be her total dividend? In other words, the dividend the company pays plus the money she's got coming in. So let's draw a timeline here. At time 1, time 2. Those are the 2 times that we're given. And at time 1, says she's going to receive $6.85. And here at time 2, she's going to receive 28 cents. And she can borrow and lend at 9%. So what she can do, if she wants to get all of her dividends in year 1, what she can do is collect the $6.85, and then she can borrow the present value at that point of this amount of money. because at the end of that time, she will owe back this 28 cents, and she'll receive that 28 cents from the company, and that will basically pay off the loan. So she can't borrow the full 28 cents. She's not going to get the full 28 cents at time one. She's only going to get the present value of it. And so she's going to receive plus 0.28 times, divided by 1.09. Why 1.09? Yeah, so it's present value is future value divided by 1 plus r to the t. R is 0.09, 1 plus r is 1.09, t is 1. That's why to get the present value of that 28 cents at time 1, we only have to divide by 1.09. And when I add those two things together, I'm going to get my per share dividend. Here's what's messed up about this problem. They actually made it minus instead of plus. Do you see that? They made it minus instead of plus. And so when we do the plus, that dividend comes out to be, what she can get right here is $7.11. And when you multiply that by the number of shares that she owns, the answer is actually $28.4275, which is one of the other choices. Do you guys see why their explanation is jacked up? It doesn't make any sense. By the way, do you know who does the explanations for these? Graduate students. Yeah. Yeah, well, so the trick is getting a professor to be willing to sit down and work through these things. Does that make sense? Yeah. So I've had, when I was a graduate student, I would have offers like, hey, I'll give you $1,200 if you'll do this solutions manual. Like, no. And so who ends up taking the work of creating the solutions manual? The poorest, lousiest graduate student. Does that make sense? Yeah. That's why we end up with these problems. Okay, next one I want to talk about is number 57. World Dumpling offered to repurchase 12,000 of its shares at $45 per share through a tender offer. So the shareholder, by the way, the tender offer is where they go out and they say, hey, we're going to pay $45 a share. By the way, the current stock price is probably, say, $42 a share. And so they're offering a premium in order to entice people to sell their shares. And apparently they offered a little too much premium because they had 16,000 shares offer up their shares. And so that means they should have offered a little less, right? Because it would have been lovely to have gotten exactly 12,000 shares tendered. So instead they've got these 16,000, and what they do is they award the sales pro rata. And so because 12,000 is, 12,000 over 16,000, that's what, 75%? And so if you're a shareholder and you offered up 500 shares, what you're going to get is 75% of 500 of your shares purchased at that price. And so that's all we do there. Take the ratio of what they're trying to sell, divide by what's offered up, assuming what's offered up is more, and multiply by the number of shares that the person has offered to sell. Pretty easy math. Market value balance sheet for Inbox System shows cash of $6,000, other assets of $19,000, equity of $25,000. The firm has 6,000 shares of stock outstanding and a net income of $4,700. Assuming the firm uses all of its cash for a stock repurchase, what would be the price per share after the repurchase? Well, they've got $25,000 in equity and 6,000 shares outstanding. How do we find the current share price? We just take 25,000 and divide by 6. And we know that with share repurchases that we're not going to actually change the share price any, just because, or in the accounting world. And so basically all we have to do is find out the original price and we have the new price. But just in case you wanted to prove it to yourself, you could figure out that there are now 4,000 560 shares, and that the reduced equity of the firm, now 25,000 minus 6,000, that's 19,000, divided by 4,560 is $4.17 a share. What's easier, going through all that math or just remembering that the share price doesn't change as a result of a share repurchase? I would just remember it if I were you. Okay, this is one of those I'm telling you to ignore. They've got these speed of adjustment values in them. If you see any question with speed of adjustment in it, just ignore it. Number 61. Pluto has 15,300 shares of stock outstanding with a par value of $1 per share and a market value of $22.10 per share. The balance sheet shows 324,800 in the capital and excessive par account, 15,300 in the common stock account, and 174,700 in the retained earning account. Just as a reminder for you guys, because I'm sure that you've forgotten it, when we're looking for the value of the total common stock that's been sold, we have to add two accounts together. We've got the common stock account, which contains the common stock at par value, and then any other money that comes in when we sell those shares gets put into the capital surplus account. So in this case, if the par value is $1 per share, if we sold new shares at $22.10, $1 would go into the par value and $21.10 would go into the capital surplus account. So that's how that works. So the firm just announced a small stock dividend of 12%. What will be the balance in the retained earnings account after the dividend? So here's what happens with a small stock dividend. We actually go ahead and increase the number, we're increasing the number of shares outstanding. We're leaving the par value the same. What does that mean has to happen to the common stock account? It's got to go up. And then the remainder of the value for those new shares that we've created goes into the capital surplus. So in this case, we've got $1 going into the par value. We've got $21.10 going into the capital surplus. But remember, we have not created any new wealth. And so that money has to come from somewhere. And the answer of where it comes from is the retained earnings account. And so both common stock and the capital surplus in a small stock dividend are going to go up, but the retained earnings, accumulated retained earnings is going to go down at the same amount. And so all we have to do really is figure out how many new shares we're going to have, multiply it by 2210 and subtract that from the retained earnings. So we said it's a 12% stock dividend. 12% multiplied by 15,300 gives us 1,836. And so we could take that 1,836 and multiply it by 2210 and subtract that from our retained earnings. And that's why the retained earnings will drop to $134,124.40. Now, here's your bonus. What's going to happen to the common stock account if we have 1,836 shares issued? What's got to happen to the common stock account? Remember, each one of the shares has a par value of $1. We've already got 15,300 shares outstanding. That's why the common stock account is at 15,300. So what we've got to do now is add 1,836 to that, and that's going to give us our new value for the common stock account. Similarly, if we were to look at the capital surplus account, what we would do is take our $22.10 minus the $1 par, gives us $21.10, and then we're going to multiply that by 1836, and we're going to add that to the capital surplus account. And those two things, the amount that they go up by is exactly the same as the amount that the retained earnings goes down by. So that's how we account for a small stock dividend. Now, when we go to the large stock dividend, something different happens. When we do a large stock dividend, we go ahead and increase the par value. And that's going to increase the amount in our common stock account, but we don't increase the capital surplus. And so the amount that our capital surplus is not going to change with the large stock value. And so what we're looking at is that's going to be exactly the same. Well, what's the common stock going to be now? 13,000 shares in common stock, par value of $1 a piece, and they're doing a large stock dividend of 40%. So 40% of 13,000 is 5,200. So we're going to have 18,200 now in our common stock account. And so it went up by 5,200. What do you think is going to happen to our retained earnings? It's got to go down by the same amount. Now the question is, why do we adjust the capital surplus account in a small stock dividend and not in a large stock dividend? And the answer is probably this. There's a good chance that a large stock dividend, that capital surplus increase would wipe out the addition to retained earnings and make it, or the accumulated retained earnings and make them negative. And so they don't do that. But once again, this is just something that accountants have come up with. It's just difference in how we handle these. Do any of these things make any difference to the value of the equity? Not one bit. Number 63. So we've got a large stock dividend, 50%, 41,800 shares outstanding. We know that means that 20,900 extra shares are going to be created, a par value of $1 per share. And so we know that common stock account is going to go up by, what, 20,900? And so what that means is that our retained earnings has to go down by that same amount. And when we do that math, we come up with 287,600. So, for both small stock dividends and large stock dividends, the common stock account gets adjusted. For small stock dividends, we also adjust the capital surplus. For large stock dividends, we do not. Any money that is used to increase either one of those accounts comes out of the accumulated retained earnings account, and it all has to add back together to be exactly what it was before, because we haven't done one single thing to increase or decrease our equity through these exercises. Let's see if I can squeeze one more in here. The Uptowner has 11,000 shares of common stock outstanding, par value of $1, a large stock dividend of 65%. What's the value of the common stock account after the dividend? Well, so what's 65%? In fact, let's say it's 165% of 11,000. Tells us it's going to be 18,150, because we just have to have an extra $1 for each one of those new shares. And so that's pretty easy.